All right, today we're putting on our detective hats. We're on the trail of a mind-boggling amount of money that seemed to just vanish from the Indian stock market. So let's get right into it. At the center of this whole mystery is this number right here, 1,60,000 crore rupees. That's about 19 billion US dollars. It's the staggering amount that foreign institutional investors, the big global players, pulled out of India in just 1 year. Now, to give you some scale, that's more than the entire annual GDP of over 100 countries. It's a truly colossal sum of money. So that immediately brings up the two big questions, right? When a pile of cash that big gets up and moves, it definitely leaves a trail. So first, where did it all go? And maybe more importantly, why did it flee one of the fastest growing economies on the planet? It's time to follow the money. Okay, first things first, we have to figure out the motive. Why would these huge global investors suddenly decide to sell off their Indian stocks and take their money somewhere else? Well, it turns out it wasn't just one single thing, but more like a perfect storm of factors all hitting at once. As we dug in, our investigation pointed to 7 key reasons that all came together to create this storm. Let's start breaking down the clues one by one. The first reason is pretty straightforward: price. The Indian market just started to look really, really expensive. Its main index, the Nifty, was trading at a price-to-earnings ratio of almost 23. That means for every 1 rupee of profit a company made, you had to pay 23 rupees to own a piece of it. But look over at China's tech sector. You could get that same rupee of profit for just 10 rupees. For a global investor just looking at the numbers, that's kind of a no-brainer. The second huge factor was good old FOMO, the fear of missing out. You see, while the Indian market was doing its thing, a full-on gold rush was exploding over in the United States around artificial intelligence. Investors started to feel like every single dollar they kept parked in India was a dollar that wasn't getting a piece of this historic AI boom. That opportunity cost just got way too high to ignore. And it didn't stop there. On top of the high prices and the AI FOMO, other problems were piling up. There was trade uncertainty with the US. Corporate earnings in India had been sluggish for 6 quarters straight. The rupee was dropping, which shaved 5 to 6% off the top of any returns for dollar-based investors. And at the same time, China's market was starting to look attractive again, and India's taxes on investment gains looked kind of steep compared to other places. Any one of these probably wouldn't have been a deal breaker, but all of them together, it built a really strong case to sell. So we've got a pretty good idea of why the money left. Now for the second half of our mystery. Where did it actually go? Let's get back on the trail. And wow, the data just speaks for itself. The returns in other parts of the world were just incredible. The US market put up a really solid, almost 18% return. Japan's Nikkei index shot up by 40%. And then there was South Korea, which just went parabolic, delivering an unbelievable 75.8% return, mostly because its companies were making the high-tech memory chips that were powering that whole global AI boom. But the biggest magnet for all this cash was, without a doubt, the US and its AI revolution. Investors flooded the zone, pouring nearly $1 trillion into US stock funds that year. Why? They were chasing the insane growth of AI giants like Google, up 65%, and Nvidia, up 41%. It was a global stampede, and everyone was running towards American tech. And this chart really puts it all into perspective. For all the excitement about India's growth story, and it is exciting, its stock market only makes up about 3% of the entire global stock market value. The other 97% of opportunities are somewhere else. And in that particular year, all the action was happening in that other 97%. Okay, so you'd think that with a $19 billion hole blown in the market, things in India would have crashed and burned. But they didn't. And this is the big twist in our story. If all that foreign money was running for the exits, who on earth stepped in to save the day? What happened was this fascinating tug-of-war. On one side of the rope, you had the big foreign institutions selling off an average of 3,500 crore rupees worth of stock every single day. But pulling just as hard on the other side of the rope were India's own retail investors. Through their monthly automated investment plans, or SIPs, they were pouring in about 1,000 crore rupees every single day. So the hero of our story isn't some huge investment bank. It's millions of regular Indian investors. That steady, disciplined, daily flow of money acted like a giant financial cushion, soaking up all that selling pressure from overseas and stopping the market from collapsing. It's a pretty amazing story.
So, we followed the money, we figured out the motive, and we've even met the unexpected hero. But what does this whole thing really mean for you as an individual investor? What's the one big lesson we should take away from all this?
Well, the first thing to realize is that this kind of thing isn't new at all. Big foreign investors pulling money out of India is a pattern. It's cyclical. It happened back in the 2008 global financial crisis, during the IL&FS crisis in 2018, when COVID hit in 2020, and again in 2022. And what does history show us? After a year or two of money flowing out, it almost always comes flowing back in.
And that right there brings us to the single most important lesson. These big foreign investors don't have some personal beef with India. It's not about loving or hating a country, it's just business. It's just math. Global money is like water. It will always, always flow to the path of least resistance, to the place where it can get the absolute best return for the risk it's taking. It is really that simple. So this whole detective story leaves us with one final, and I think pretty provocative thought. This giant pool of global capital is constantly scanning the entire planet for the next big opportunity. And understanding that mindset helps explain why it moves the way it does. It's a powerful reminder that while India is a huge and important part of the story, it's still just one part of a much, much larger world of finance, a world that's 97% bigger. And that's a perspective that's definitely worth remembering.